Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. So glad to have you tune in into this episode. I like to start the day by renewing our mind, and I have for us today a verse from Philippians chapter 4, verses 11 and 12. I am not saying this because I am in need, for I have learned to be content, whatever the circumstances. I know what it is to be in need, and I know what it is to have plenty, and I have learned the secret of being content in any and every situation, whether well-fed or hungry, whether living in plenty or in want. And if you want to know the secret, you're going to have to read verse 13. If an apple a day keeps the doctor away, what does an onion do? Keeps everyone away. Why was the jack-o'-lantern afraid to cross the road? It had no guts. In Chapter 7, we dive into retirement withdrawal strategies, and we're going to look at the 4% withdrawal rule, the bucket strategy, which is similar to the barbell strategy, dynamic withdrawals, the RMD rule, spending floors, only spending dividends and interest and never touching the principal. And there are pros and cons to each of these strategies, but at the end of the day, you're going to need to pick the strategy that makes the most sense for you. If this is the first episode in the series, be sure to listen to the first 6 chapters. In each chapter of my book, I share core concepts that you're going to want to consider as you prepare for your retirement. My new book has a total of 13 chapters, and next week in Chapter 8, I'm going to be discussing investing in retirement. Each chapter of the book provides retirement education. But when you're ready to start building your retirement plan, you will want to sign up at retirementbudgetcalculator.com so that you can begin to see how the numbers will work for your specific situation. Retirement's a big deal, and it can feel overwhelming because this is not something that you do all the time. In the Retirement Budget Calculator, we created a private community portal where other smart people on this retirement journey can share with one another their wisdom and their stories. Our community is called the RBC Nerds. Some people have recently retired within the community. Some people have been retired for years, and some people are getting ready to retire. Whatever the case may be, we have other people in the community who can help guide you to success. For those of you who are already part of the RBC Nerds community, I want to be sure you check out the latest checklist that I uploaded called What Issues Should I Consider Before I Update My Estate Plan? Chapter 7, Retirement Withdrawal Strategies. During retirement, most people want to spend their time with the people they love and spend their money in a way that brings meaning to them. Most want to enjoy a lifestyle similar to their pre-retirement standard of living, but they don't want to be a retail greeter at age 85 because they've run out of money. Figuring out strategies to manage cash flow throughout decades-long retirement is no easy task. Each retiree will need to take an individualized approach to manage their retirement funds for the long haul. However, many well-researched retirement withdrawal strategies aim to help retirees manage their money during retirement. If you're starting to think about retirement, considering a withdrawal strategy could make sense for you. Before thinking about withdrawal strategies, the withdrawal strategies that I'm about to lay out differ, but most share a common foundation. To successfully implement strategies, retirees and their financial advisors need a solid understanding of their personal finances. These are a few of the key numbers that people need to know before figuring out retirement withdrawal strategies. Number 1, annual spending. This figure represents the total you plan to spend in a typical year. The Retirement Budget Calculator allows users to forecast their spending, including expected inflation, throughout their lifetime. Number 2, discretionary versus necessary spending. During retirement, certain expenses such as food or medical care are necessary for retirees. However, other expenses are discretionary. Making clear boundaries between necessary and discretionary expenses makes it easier for retirees to consider what costs they may be willing to cut during an underperforming market. Number 3, total spendable assets. This is the amount of money in retirement, brokerage, and other cash accounts. If you plan to sell a major asset, such as real estate, before retirement, you may want to include the value of that asset as well. Number 4, expected guaranteed income during retirement. Most people will have some sort of guaranteed income during retirement, and this includes income from Social Security, workplace pensions, annuities, and any other form of income that you can expect to last during retirement. The Retirement Budget Calculator can help you to get all of these numbers on a personal level. having that information at the ready can make it easier for you to put numbers into some of the following examples. The 4% rule. One of the best known retirement withdrawal strategies is called the 4% rule. Under this withdrawal strategy, retirees withdraw 4% of their portfolio the first year of retirement. In subsequent years, they increase the amount they withdraw by inflation, which is typically the Consumer Price Index for all urban wage earners, or CPIU as it's commonly referred. For example, a couple that has $1 million invested would withdraw $40,000 in their first year of retirement. If inflation is 3% the next year, they will withdraw $41,200. Over time, their withdrawals only change based on inflation. The performance of the market does not play into the withdrawal strategies. Some people call this the 4% safe withdrawal rate. This indicates that retirees using this strategy have a low likelihood of running out of money during a 30-year retirement. While no withdrawal strategy is perfectly safe, this one tends to be the more conservative than some of the other strategies. This strategy was initially developed by William Bengen in the late 1990s. He based his initial work on a 30-year time horizon. Later on, Bengen expanded the study to include more asset classes and different investment mixes. In the later studies, Bengen concluded that withdrawal rates may be somewhat higher than the 4% rule. However, the rule itself is still called the 4% rule. People who are planning their own withdrawal strategy may be attracted to this strategy because of its simplicity. Retirees only need to watch inflation to figure out the amount to withdraw. However, this strategy may be best suited to high net worth retirees who can manage their expenditures on a relatively low percentage of their portfolio. The bucket strategy. The bucket strategy is a retirement withdrawal strategy that helps retirees segment their money based on time. Under this strategy, funds needed in the short term are invested more conservatively. It may be in CDs, money market accounts, high yield savings accounts, or other investments that are expected to have low volatility. Long-term money can be invested more aggressively, even in stocks. The amount of money in each bucket depends on the retiree's expected spending over different time horizons. For example, a retiree who needs to withdraw $20,000 per year may have between $60,000 and $100,000 in short-term accounts. The remainder may be invested in more moderate or more aggressive investments. Because money in the short term is conservatively invested, retirees may feel more comfortable with volatility in their long-term investment bucket. By allowing some money to remain in growth-oriented investments, retirees are more likely to see their overall returns exceed inflation in the long term. The Retirement Budget Calculator offers a buckets visualization for users. This may help guide users to think about matching their time and their financial risk profiles. This bucket investment strategy is generally the most helpful for retirees who have variable needs over time and will want their withdrawal strategy to reflect those needs. We'll discuss bucket strategy in more detail in Chapter 8. Guyton-Klinger dynamic spending. Dynamic spending withdrawal strategies aren't quite as simple as the strategies we've already covered. Under dynamic spending strategies, retirees may have the freedom to spend a bit more liberally during the first year of retirement. However, they must adjust spending based on market conditions and inflation. High inflation combined with a down market may lead to some belt tightening during the retirement years. The Guyton-Klinger dynamic spending strategy starts out fairly simply. Retirees may withdraw between 5.8 and 6.2% of their portfolio in the first year of retirement, and the actual amount of withdrawal depends on the retiree's strategy. If the market goes up, then the retiree adjusts their withdrawal for inflation. However, if the market drops, the withdrawal amount freezes. For example, a person with a $1 million portfolio may withdraw $62,000 in the first year of retirement. The next year, if the market is up and inflation was 3%, the retiree withdraws $63,860. If the market subsequently falls, the withdrawal freezes at $63,860. The withdrawal amount remains frozen until the market has a positive annual return. After that, the retiree can adjust to the $63,860 by the amount of inflation that year. This dynamic withdrawal strategy also has exacting strategies for how retirees should rebalance each year and which asset class should support their withdrawal. The Guyton-Klinger dynamic spending withdrawal strategy looks over 40-year retirement windows. Jonathan Guyton and William Klinger set the rules based on a 1973 to 1974 retirement date. Based on a double whammy of poor market performance and inflation, this was statistically the worst time to retire in recent times. They then tested the rules using a more robust statistical method. While the dynamic spending strategy rules are complex, they may be more appealing to retirees who hope to spend more during the early retirement years. I'm not aware of a dynamic withdrawal strategy calculator, so retirees may consider consulting a fiduciary financial planner to help them execute this withdrawal strategy. In some cases, the actual implementation of the strategy may look a lot like the buckets approach to withdrawals. That includes more conservative investments for shorter-term investing and more aggressive investments for money needed in more than a decade. Vanguard Dynamic Spending. The Vanguard Dynamic Spending withdrawal strategy seeks a middle ground between portfolio longevity and spending freedom. This approach recognizes that retirees would like to spend more money if it's available due to market conditions, but they may be willing to cut back if market conditions require it. Under this paradigm, retirees withdraw a set percentage of their portfolio each year, say 5%. However, the percentage of retiree withdrawals never increases by more than 5% from the previous year. Likewise, it never falls below negative 1.5% of the spending from the previous year. If the portfolio grows by 10% in the second year of retirement, the retiree will increase withdrawals by 5%. If it decreases by negative 10% the following year, they will decrease withdrawals by negative 1.5%. This strategy assumes that retirees have some flexibility in their spending. If every dollar in a retiree's budget goes towards necessities, a 1.5% decrease in withdrawals could be a problem for that retiree, especially if it's paired with inflation. Required Minimum Distributions Rule, sometimes called the RMD rule. The Required Minimum Distribution approach to withdrawal bases withdrawals on the retiree's life expectancy and the present value of the portfolio. Under this strategy, retirees withdraw based on a uniform life table. The uniform life table adds 10 years to retirees' expected lifespan, which is considered the distribution period. The value of the portfolio is divided by the distribution period to determine the annual withdrawals. Early in retirement, the withdrawals will be a low percentage of the portfolio value, even less than 4%, potentially. While later in retirement, the percentage withdrawals will increase. If you make it to 115, you'll withdraw more than 50% of the portfolio each year. Morningstar's Christine Benz offers insights to show that mimicking RMDs helps to balance both portfolio valuations and longevity concerns. Unfortunately, this approach has downsides too. During the earliest years of retirement, the percentage of withdrawals is small. Retirees who want to spend more early in retirement while they are still physically healthy may not like the lower withdrawal percentage, even if it ensures more optimal withdrawals over time. Spending floors. The spending floor approach to withdrawals is a safety-first approach to retirement planning. It emphasizes feeling comfortable with retirement spending while allowing retirees to manage an investment portfolio for discretionary expenses. Retirees who want to use the spending floors approach need to understand their necessary expenditures and how much income they receive from guaranteed sources such as Social Security, pension income, and annuity income. This strategy recommends that retirees purchase enough guaranteed annuities to cover any gaps between their necessary expenditures and their guaranteed income sources. However, there's no need to fully pensionize a retiree's full portfolio. Discretionary expenses may be funded through more aggressively invested investment portfolios. Retirees may opt to spend discretionary funds early or later in retirement as long as the portfolio allows continued expenditures. Your secure income score, as discussed in Chapter 2, is a key indicator of success under the spending floors approach. This score divides necessary expenditures by guaranteed income in retirement. Never touching the principal. Retirees who are especially concerned with portfolio longevity and especially capital preservation may prefer a withdrawal strategy called never touching the principal. Under this strategy, retirees spend dividends and interest income from their portfolio, but they never sell the underlying shares. If the portfolio appreciates in value, dividends and income should theoretically increase alongside the value of the portfolio. This strategy is similar to the strategy of a real estate investor that only relies upon cash flow to fund their living expenses. The investor may spend cash flow from the rental income, but they do not plan to sell or to put a mortgage on any of the investment properties. In this way, the underlying value of the real estate portfolio remains intact and future cash flow is more likely preserved. While never touching the principal is a great way to maximize portfolio longevity, it may mean smaller expenditures, especially in the early years of retirement. Key takeaways. We've covered 7 of the most popular retirement withdrawal strategies. Each has been studied in depth and could help retirees manage cash flow without worrying about a depleted portfolio. However, none of the strategies are foolproof. Each one could lead to financial difficulties due to market underperformance, inflation, or unexpected financial needs. The retirement budget calculator may help you estimate these effects, but it does not cover every situation. It is designed with an emphasis on cash flow and is designed for those seeking a "can I afford to retire" calculator. Still, to maximize the likelihood of success, retirees will want to exercise discipline in adhering to their strategy. Retirees are more likely to have success by sticking with a strategy that matches their goals. If you're not sure which strategy works best for you, you may want to work with a fiduciary financial advisor who can help you review your personal situation.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent, fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.